Hello and welcome to this podcast. In this podcast, we're working through the tax implications of leasing. And in this podcast, we're going to have a look at the VAT implications of leasing, and we're going to combine that with the income tax effects. So let's begin. In our previous podcast, we established what we meant when we talked about leasing and an income tax consequence. In our previous podcast, we established what we meant when we talked about leasing in an income tax context. And we said that all purchase and sale transactions have a cash component and a finance component, whereas all leases have a rent income and a rent expense, but the asset remains the asset of the lessor for income tax purposes. And we showed how that was different from how we might disclose it for financial reporting purposes. Now we need to establish a new set of principles around these sorts of transactions for VAT purposes. And the VAT Act distinguishes between two different types of transactions: Instalment Credit Agreements and rental agreements. And under Instalment Credit Agreements, it has two types of transactions. It has supplies in the course of a sale, and it has some criteria around what kind of sales are Instalment Credit Agreements. Essentially, it relates to deferral of payment and the way in which the ownership of the asset is structured. And the second type of transaction is those supplied in terms of a lease. And again, it has some criteria of what kind of leases meet the definition of Instalment Credit Agreement. Again, it has to do with payment over time, those payments exceeding the cash value of the asset, and some other criteria as well. If you're not familiar with the definition, I would suggest that you have a look at it in the VAT Act. All other transactions that are not Instalment Credit Agreements are rental agreements. Now, how does that differ from income tax? Well, leases should be rental agreements. Pretty much all suspensive sales, in fact, I think it's safe to say all suspensive sales would be Instalment Credit Agreements. But some leases will be Instalment Credit Agreements. So some things that we are treating as month by month for the purposes of income tax have upfront consequences for VAT. Let's have a look at what those consequences are. And I'm going to show the income tax and the VAT effects combined. So in the first combination, we've got those transactions that are suspensive sale agreements for income tax purposes and installment credit agreements for VAT purposes. That means for income tax purposes, the seller purchases the asset and claims a deduction. The seller has gross income of the cash price when they sell the asset, and they have interest income over time as they provide financing to the buyer. For VAT purposes, they claim an input on the purchase price when they buy the asset, and they recognize VAT up front on the cash selling price. Even though they haven't received all of that cash selling price yet, they must still pay the VAT output up front. The buyer now owns the asset, claims capital allowances on the asset, claims an interest deduction over time as they pay off the financing of the asset, and claims a VAT input upfront on the cash selling price of the asset. The second kind of transaction is that which is a lease for income tax purposes and a rental agreement for VAT purposes. And again, in these two, the income tax and the VAT matches up nicely. So the lessor continues to claim capital allowances and the lessor has rent income. The lessee has rent expense. The lessor claims a VAT input when they purchase the asset, and then they recognize a VAT output each month when they receive or bill for their rent income. As a result, their rent income shown for income tax purposes is excluding the VAT component that they have charged to the lessee. Likewise, the lessee claims an input for each month's VAT, or each month's rent, and the VAT on that rent. And so their income tax consequences are the rent expense excluding the VAT that they have been able to claim back. The most complicated combination is for a transaction which is a lease for income tax purposes, but is an installment credit agreement for VAT purposes. That means for VAT purposes, the lessor and we're calling them the lessor because we're thinking income tax. But the VAT consequences for the lessor are input VAT on the purchase and VAT output on the supply of the asset to the lessee based on the cash price and payable by the lessor up front, notwithstanding the fact that they haven't received all of the cash price yet, and notwithstanding the fact that for income tax purposes they are being treated as a lessor, so they have rent income every month. So for income tax purposes they have rent income each month, and that rent income has no VAT component to it. The money that they receive each month is entirely theirs to keep. They have to pay no part of that rent income to SARS at all. So the rent income that they receive is all recognized as gross income. The lessee has rent expense each month. Now, no part of that rent expense is recoverable from SARS. So in theory, you would say that all of that rent expense should be shown as a deduction. However, Section 23C of the Income Tax Act says that in a lease transaction, the lease expense claimed must be reduced by a proportion of the total input VAT claimed up front. So you would take the total input VAT and multiply it by this month's rent over the total rent to get a proportional amount of the VAT. And you would subtract that from the rent expense, and the lessee would claim a net amount. Now, you might say, but hang on, the lessor is being taxed on rent without any adjustment, but the lessee is able to claim rent less a VAT input amount. So there is more gross income than there is deduction. The way this is fixed is through the capital allowances that the lessor is entitled to claim. The lessor should claim their capital allowances on the cost price of the asset, excluding the input VAT that they claimed up front. But in order to balance the two sides, SARS allows the lessor to add the output VAT that they paid to SARS up front to the cost of the asset. So they're not adding back the input VAT that they claimed, they are adding on the output VAT that they had to pay, which may be more or may be less than the input VAT. So their capital allowances are being increased, so they're claiming on more than the cost, but their rent income is not adjusted for VAT. So over time, the extra capital allowances will offset the fact that the rent income is not adjusted for VAT. That might work nicely in as much as it will balance every year, but more likely it will just have to balance over time, and year by year there will be a little bit of a residual effect. So that's how they do it. They don't want to adjust the rent income amount, because once we start adjusting income amounts in that context, it would create problems in other transactions. So let's see how this all plays out in 3 examples. In this first example, we have a lease for income tax purposes, which is not an installment credit agreement for VAT purposes. So B rented a machine from A for 114 Rand, including VAT, for 3 years. B used the machine in a process of manufacture. A had purchased the machine for 285 Rand, including VAT. You are required to calculate the tax effects for A and B in year 1. So to start with, A purchased this machine, and when it purchased it, it would have claimed a VAT input of 35 Rand. A is the owner of the machine, so A claims wear and tear allowances on the amount excluding VAT, and because it's used in a lease transaction, they have to claim only 20% in year 1. Then A is renting the machine to B, so A has got output VAT on the rent as it's charged every month or every year, and A has gross income of the rental amount excluding VAT. B is renting the machine, so B has VAT input every month or every year, and B has a rent expense of the amount excluding the VAT input that it was able to recover. So there, nice and simply, the income tax and the VAT both happen month by month. In our second example, we have got a purchase and sale for income tax purposes that is an installment credit agreement for VAT purposes. So B purchased a machine from A in a suspensive sale for a total of 400 Rand, payable in annual installments in arrears over 5 years. The cash price of the machine would have been 285 Rand, including VAT. The interest rate in terms of the contract is 12.5% per annum. You're required to calculate the tax effects for A and B in years 1 and 2. And again, I've given you an amortization table just that you can see what the interest is in each period. So A has purchased this machine. A claims a VAT input on the purchase price. A is the owner of A has now sold this machine. So A purchased this machine, so A has claimed VAT input on the purchase price, and it purchased it with the intention of selling it, so it's trading stock. That means they can claim a Section 11A deduction of the purchase price net of the VAT input. A has then supplied this machine to B and must have VAT output on the cash price, so 285 times 14 over 114, and has gross income of the cash price net of the VAT output paid to SARS. Then there's the financing component, and A has interest income of 36 Rand in year 1 and 30 Rand in year 2. There are no VAT implications for the interest income. B has had this machine supplied to it, so it can claim a VAT input all on day 1, even though it may not have paid anything like that amount on day 1. In fact, it probably only pays at the end of the year. So it claims the VAT input. It's now the owner of the machine, and it can claim a Section 12C allowance on the purchase price net of the VAT, so 285 minus 35. And because this is not a leasing transaction, it can claim 40% in year 1 and 20% in years 2, 3, and 4. And then finally, B has got interest expense, and that is deductible each year. That is the cost of financing this transaction. Now, the most complicated example is one which is an installment credit agreement for VAT purposes, but a lease for income tax purposes. So we've been specific here in saying that B leased a machine from A for 75 Rand per year, payable annually in arrears for 5 years. The agreement included that the lease payments included finance charges of 122 Rand, calculated at 12.5% with an implied 32 Rand residual value, and required that B be responsible for insurance, repairs, and maintenance throughout the lease. Now, all of those things together means that this meets the definition of an installment credit agreement. The cash price of the machine, again, would have been 285 Rand, including VAT. And A had purchased the machine for 285 Rand. You're required to calculate the tax effects for A and B in years 1 and 2. So, A has purchased the machine and claimed VAT input in year 1. For VAT purposes, they have supplied this machine in total to B in year 1, and they must recognize VAT output in year 1 on the cash price. However, for income tax purposes, this remains a lease agreement, and so they show gross income every year of the lease payments. So they're leasing it for 75 Rand a year, so they have gross income of 75 Rand a year. There's no VAT adjustment to that 75 Rand. All of it is received by A for its own benefit. For income tax purposes, A still owns this asset, so they're entitled to claim capital allowances. And here is where we make the adjustment to the amount on which they claim the capital allowances. Their purchase price was 285 times 100 over 114 to be the amount net of VAT, and they're allowed to add another 35 Rand to the cost. That 35 Rand is not the VAT input they claimed, it's the VAT output that they paid to SARS. Now, although both numbers are 35 Rand in this example, it could be that the VAT output be different from the input. That's fine. We must use the VAT output paid by A to SARS and increase the cost by that amount. And because it's a lease transaction, they pay or they claim 20% per year. There's no 40% in year one. I haven't made any adjustment for the 32 Rand residual value because this is a Section 12C asset, and the residual adjustment is from Interpretation Note 47, and that refers to Section 11E. B is entitled to claim VAT input up front of 35 Rand. For income tax purposes, this is a lease agreement, so they have rent expense. It would be 75 Rand a year, but it is reduced by a proportional amount of the total input VAT claimed. So they claim 35 Rand, and this lease is going to run for 5 years, so they reduce that 75 by 7 Rand per year and claim the net amount of 68 per year. I hope that's been helpful, and I hope it helps to illustrate how the three different combinations work for income tax and VAT purposes. Thanks for watching.